Welcome to today's webcast. KPMG has been approved by NASBA to deliver CPE-worthy training. In order to receive CPE credit, you must attend for the entire session and participate in interactivity checks. Interactivity checks will appear on top of your media player and may or may not be verbally addressed by presenters. Participation is tracked, and failure to participate will result in denial of CPE credits. If you have any technical issues during the webcast, please submit a question through the Questions and Answers panel, and our producers will respond to you directly. Please submit all content-related questions through the Questions and Answers panel.
Good afternoon and welcome. My name is Mike Musso, and I lead the Consumer Retail Turnaround and Restructuring practice here at KPMG. Really glad you've joined us today. I'm excited to share the panel today with two really esteemed colleagues with whom I've had the pleasure of working with over the past couple of decades. Ron Gold from Frost Brown Todd and Joe Massaroni from Gordon Brothers are joining me today for this fireside chat to talk about the current state of the retail and consumer products industries. We hope to cover a lot of ground. Before we venture farther into that discussion, starting with Ron, can I ask each of you to give a brief introduction?
Mike, thanks, and good afternoon, everyone. My name is Ron Gold. I am with Frost Brown Todd in Cincinnati, member of our bankruptcy and restructuring group. I also chair our shopping center and retail practice, having focused on retail and insolvency matters for over 30 years.
Joe?
My name is Joe Massaroni. I work with Gordon Brothers in their valuation and appraisal division. I've been with them for just under 2 years, covering new business in the Southeast market. Prior to that, I spent 30 years as an asset-based lender, primarily with KeyBank, Wells Fargo, and Truist Securities.
Thanks, gentlemen. You know, we've been talking about this for a while now. Hearing recession for over a year, a lot of retailers and brands are trying to position themselves to really survive a lot of uncertainty and obviously continue the growth. But over the past couple of decades, those of us who have been exposed to retail or work in these channels have seen very few sectors that have ever faced the magnitude of change that retail and consumers face. The industry's, it's weathered a lot of revolution, and evolution is probably too mild. Consumer demands, shopping habits, it's been a complete transition out of traditional malls. And really, we've seen, early on in the decade, a real new footprint in retail brick and mortar. But as you look at it too, you throw on top of it the e-commerce explosion, last mile shipping challenges, mobile media, online reviews, supply chain transparencies, and now ESG. It's all part of an ever-changing landscape. COVID provided icing on the cake in terms of challenges to the retail industry. This all makes us think it would be nice to go back to the days of 8-track players and just stay there. But we can't. And as the pandemic restrictions really cooled off in 2022, many retailers, I think, thought they had time to breathe. And now they're met with the highest level of inflation over the last 40 years and record interest rate hikes. Yet, through it all, we hear record spending on Black Friday, over $9 billion, and it appears consumers are relentless in their spending habits. So what's it look like in the future with all these mixed messages? Ron, let's start with you. Given all this change and noise we hear from the industry, from the media, and so forth, what is your perspective on the real state of the economy today?
Well, Mike, I think my clients are in a great state of uncertainty right now. For many of them, 2022 was a good year. Dealing with supply chain, and they were able to make it through it. But they really don't know what to expect next year. They're starting to see some distress with their customers and their suppliers, and they're really trying to react and how to figure out where to go next year. We've started to see a number of bankruptcy filings in the fourth quarter of 2022. For bankruptcy attorneys, 2022 was a slow year, and I know that's not disappointing to the bankruptcy bar, but for everyone else, it's it's welcome news. And I often say bankruptcy is perhaps back where it belongs on the front page of the New York Times. You're seeing it more and more often. But I think with our clients, there is concern about what to do, and they're starting to figure out how to plan for next year and be prepared for what may come.
Right. And Joe, I mean, you obviously work daily with a number of retail clients, both who are experiencing distress and those that are growing. What's your perspective on the economy right now from your side of the fence?
From where we sit, Mike, right now, from where I sit, really, there's a true distinction between the haves and the have-nots. Certain retailers and even consumer product companies have, I would say, used the supply chain issues to their advantage, and they found a way to manage their inventories better and bring them more in line with where they should be. However, there are a number of companies out there today who are struggling with liquidity issues. They've over-purchased because they base their projections on COVID-related performance, and they assumed that the consumer would go back to the stores or go online and purchase more goods for themselves. Well, the consumer has certainly taken a shift, and they're back out there traveling again and doing things, whether it's on an airplane, in a car. They're getting out of the house more, and some of those products are no longer being purchased at the rate which they were the last 2 years. So from my perspective right now, there are companies that have the liquidity and the operational efficiencies to move forward in a positive fashion. And then there's other companies that are going to struggle.
But Joe, is it across the board? Are you seeing that in retail? Because we're seeing it by industry segments, whether it's fashion or automotive or consumer home goods. It's a shifting there. I mean, we're seeing certainly issues in the automotive sector because it's taking longer to get cars out from the manufacturing, and that's impacting some of the dealerships out there. Consumer goods. I mean, there are some companies that are thriving, but some that, they did fantastic in 2020, unexpectedly during the pandemic when people were home and perhaps needed or wanted more of the home consumer goods, may not be doing as well now. And certainly when you look at apparel, there's certainly a downturn we see for some of our clients who work and deal in that industry, some type of downturn, right? That they just don't think there's going to be the continued demand. Are you seeing that as well?
Now, in certain instances, in certain segments of the apparel industry, yes. But to kind of take your question and kind of divide a little bit, Ron, I think the first piece of that is it goes back to what I said before. It really depends on how much inventory they've put on their shelves or in their warehouses and what they can sell through this holiday season. I know the first couple of weeks of the holiday season have been somewhat positive from certain aspects in that sense, and Mike quoted the early $9 billion record Black Friday sales, but some of those sales too are based on inflated prices. So the price of retail and consumer goods has gone up considerably over the past 6 to 12 months, and that's driving some of the increase. If you break it down and, at the end of this particular cycle, you look at the number of goods or the number of pieces sold, that number of pieces is relatively the same or maybe even a little less.
So how do you explain, though, all the noise that we're hearing about consumers are nervous, we're expecting unemployment to pop up in the first quarter, gas prices are astronomical. Where's the money coming from that we're seeing being spent? And how can you explain the gap between consumer sentiment and everything else you're hearing relative to inflation and cost of goods? Joe, why don't you start there?
Mike, I think the biggest driver here is access to capital. And, unlike, 15 years ago when we had the Great Recession, people have a lot more access to capital today, whether it be credit cards or loans that they procured before this actual period hit. And what I mean by that is, during the pandemic, we received several stimulus packages, and the government effectively helped the homeowner pay down maybe a mortgage, a car, a credit card. And if that credit card, more importantly, was paid down all the way, then now the consumer feels as though they have the liquidity to go out and spend. The problem is that the inflationary issues, including the recent rate hike, those haven't hit the consumer yet, and they're about to hit them. And as things progress here over the next 3 to 6 months, it's going to be difficult for some of those consumers to navigate through their own personal debt if they've already started to increase what they're spending.
So obviously, go ahead, Ron. Go ahead.
I was just going to say, when you look at the consumers and you look at consumer bankruptcies, what's happened is it was down significantly during the past 2 years. There was the stimulus money. There was relief from student loans, even though you can't really discharge those in bankruptcy, and there was relief on evictions and rent and moratoriums out there. And as some of those are easing, you're seeing studies that are projecting that the consumer bankruptcies are going to rise over the next 12 months. Medical costs are going up. I think the inflation is going to take effect. Whether this was a final spending spree for people, or once again they felt some spending freedom to hit the stores, as Joe said, or go on vacation and travel and just enjoy the season, not really certain. But the projections are that we're going to see more consumer bankruptcies next year, which is going to dramatically impact the retail and the whole supply chain, where we spend more of our time.
So just playing that scenario out, there enters in, negative sentiment coming up after the holidays. People have spent, I guess, the last that they could afford to spend. Joe, you've got a unique perspective in advising clients in your many years as an asset-based lender. What are you telling clients from your expertise right now, retailers and brands, how to weather this storm in terms of how they manage working capital?
Yeah, Mike, there's two things really, and two big drivers that I see. And the first one, I've already said it a couple of times, is really you need to skinny down the inventories. Look at your projections, give them the once over, and really understand them for what they are. And what I mean by that is, are you basing your projections on COVID performance? And when we look at COVID performance, there were a lot of consumer products that were purchased that are not repetition purposes. They're one-time purchases. Maybe it was furniture, maybe it was patio accessories, whatever it may be. Those things are not consistently going to be in the headlines in terms of what's going to be the most purchased item this year at Christmas. Mm-hmm. So the first thing is really skinny down your inventories. Take a haircut on your own projections. Better to be 5 or 10% short than to be 20 or 25% over, because the cash you could be saving there, or the cash you could have on the balance sheet, could help you through a more difficult period here as interest rates continue to go up. The other thing
don't you think, though, the hay's in the barn right now with regard to inventories? We're probably already seeing people going, oh my God, I've got 20 weeks, 30 weeks of inventory with a, supply chain that can turn it back to me in 8. What do I do? Joe, I'm sure you face that with your clients as a lender. What is your advice to them on inventory right now? Do you wait and see how the rest of the holiday season goes, or do you start taking action right now?
The action is now, Mike. And if you are in that position right now, the best course of action is to start discounting. And look, a lot of the major retailers will discount post-holiday season, and they will try to expunge themselves of we'll call it the leftover inventory, the inventory they wanted to sell during the holiday period. But take those discounts now, and you'll feel better about it in a couple of weeks when you don't have as much inventory that you're discounting to a much more significant degree.
Got it. So,
But
Ron,
Mike, the issue,
go ahead. Go ahead, Ron.
but the issue largely is when you talk, and I'm representing folks more on the supply chain side and filling up the retailers. I mean, we're already talking about end of Q2, Q3, and way down the road what the orders are coming in for, and we wonder in some respects whether the retailers are giving accurate orders and what they feel they need. I mean, for our clients, I mean, if you look at what Joe's saying and his thoughts are reduce the products, that means my folks on our end are going to have to discontinue lines or something else, or find alternative sources for it, such as the liquidators or some of the outlet locations. But it's a challenge for us when we are really looking far down the line. I mean, I appreciate that the retailers are all, as Joe said, are looking in the short term, and frankly, the advice that Joe's giving, and it sounds like it's coming from a recovering banker, of what he wants to hear on the first meeting, and the questions he's going to ask. Have you done the litany of things that he just said? And I'm sure Joe's experience will tell you he's rarely heard yes to those questions at the first meeting. And having sat with the clients who are at those meetings, we probably haven't done them either. So it's a challenge for those in the supply chain, because we're shifting. Historically, you've been planning for this many products to go out the door to X, Y, and Z, and I'm not sure that looking at the holiday season is going to be reflective of what the actual needs are in 2023.
So, Joe, on that same subject, are you getting calls now? Is Gordon Brothers starting to see a ramp up of activity with people's realization that they're going to have a lot of excess and they're going to try to beat others to the punch in terms of liquidating inventory?
Yes. And Mike, that's coming from two different aspects. So let's first take that from the lender's perspective. And the lenders are calling us earlier now because they see the signs, they see the cracks, and they're saying, hey, my customer's inventory went up, let's say 35% since the last appraisal. Well, their revenues are only up 10% and their margins are down a little bit. Will that affect my valuations? And the answer is yes. That's going to significantly affect the valuations. And that I would say taking the first step and asking the question is obviously important, but that needs to be followed up. What more lenders need to be doing, or what more companies need to be doing, better yet, is coming to someone like a Gordon Brothers and saying, I have overstock. I need some help moving this product so that I can get more liquidity into my business. And Ron's going to say I sound like a banker again, but the liquidity, we've said it so many times, it is so cliche, cash is king. And to be sitting on an additional $2 or $3 million of inventory when you can have that working capital on your balance sheet in the form of cash is extreme. There's a big difference. And it's extremely important that these companies begin to see what's happening right now, because the Fed raised interest rates. When's that going to take effect? Well, that's not going to hit them tomorrow. That's going to hit them in 30 days or 60 days, 90 days, when that interest bill comes every month and starts to pile up, and it's just that much larger each month. That's going to take a toll on their balance sheet. And to be sitting on that excess inventory, then they may have to discount it even more at a later point in time. So calling someone like a Gordon Brothers, having us come in, take a look at the situation. We may, there may be something we can do. There may be, different avenues. We may tell the customer that they're in great shape and that our perspective on their particular industry is such that they'd be best suited to hold on to their inventory for that period of time, which you haven't heard me say, and I probably won't say again.
Are you expecting lenders to become pretty aggressive in reassessing valuations after the end of these holidays and really taking a very, very detailed look at inventory they're lending against?
Mike, that diligence has started already. And we see that because we are flush with appraisal requests. I'll give you a good example. A year ago, if a new lender walked into their credit person and said, I have this 6-month-old appraisal, I'd like to lend on this, or maybe even a 9-month-old appraisal. Well, that credit group and that bank, they may have gotten comfortable with that appraisal in the past. Now, banks are looking at appraisals that are 90 days old, and they're calling them stale. And they look to us to update that analysis, go through what we go through in our process, and provide new valuations. In most cases, those valuations are going down, but in some cases, they're maintaining or they're stable or even increasing.
So how would you suggest a client prepare for a reevaluation of their inventory value? Is there anything they can do to prepare for the lenders coming in?
There's a couple things, and timing is one of the biggest, Mike. And we've had a few instances where we've started an appraisal and realized we're at the company's high point of inventory and low point of margins. And over the last 12 months ending XYZ date, margins were down slightly and inventory was up 15%. But if we waited 60 more days, this is the client. If the client waited 60 more days, inventory may have been down 5%, price increases may have taken hold, and it is a much better situation for them from a valuation perspective. So from a client's perspective, the way to prepare is look at your own margins, look at your inventory levels and see where they're at. It may or may not be the best time for you to go out and say, I need a new valuation. I want this updated. Customer feels they're doing great because their demand's up 15%. Margins are down 2 points and inventory is up 40%. That's going to have a declining effect on their valuations.
Got it. So shifting gears to now looking at the future and what's happened in the past in terms of the M&A market. We just came off probably, arguably, the best 24 months, really, if you go back 36, of an M&A market that none of us have seen in our times. And all three of us have been around a long time, especially you, Ron. But as we look at it, Ron, what do you think we're going to see from the M&A market over the next 12 to 24 months? Not only in activity, but in terms of valuations and multiples.
So we really are coming off an unbelievable run in the M&A market, and we're still closing the deals that have been started earlier this year. It's remarkable. I mean, when you look at the valuations, we had clients throughout this past 12-month cycle who saw a peak performance and maybe would have liked to have held on to the company a little longer, but decided now's the time to get out because they looked into their crystal ball, Mike, and they saw concern. I mean, listen, everybody's been saying that distress and it can't continue at that level. We've been projecting that since 2021, 22, and now into 2023 when it's coming. But those folks who got out at the beginning of the year, in the middle of the year, or just coming out now, have really done remarkably well. And it was in all segments. So we continue to see it. What do we think is going to happen next year? I think we're going to see the distressed deals. I think we're going to go from not seeing deals worth distress, but we're going to see transactions where customers are going to force a sale because they're unhappy. And customers, and I'm talking about on the supply chain, where they're going to force the sales because they're unhappy with performance and the liquidity of one of their customers. You're going to see those where the bank's going to cut liquidity that the company just can't operate, and then they're going to try to do a going concern sale as opposed to a liquidation. Do I think these will end up in bankruptcy? Some will, but I think we're going to see what we'll view as a lot of distressed transactions. There's some segments that are hurting, and it's how quickly our clients are able to react and identify the trouble that's coming their way will help them with the valuation. I mean, I truly believe that none of my clients should be surprised when the company comes to them and says, we're in distress. There are the warning signs. They have to do a better job of monitoring their clients. Have their payables started to trickle up? And on the reverse side, their suppliers, are you seeing delays in what you're seeing? Are you seeing constant price increases? It's pricing in the supply chain that ends up in the retail thing that is going to drive things. My clients are facing constant demands that we're not paying sufficient, and that, for every widget, if you will, that it costs $3 to build, they're only selling for $2.50. They can't do it anymore. But once again, the clients need to spend more attention on the detail rather than being surprised.
So, Joe, as you look at this M&A market, are you starting to hear from your clients out there that, hey, we're thinking about 2023 as a year to monetize our assets, especially in the PE world? What are you hearing with your ears to the ground?
Right now, Mike, everybody is kind of taking a cautious approach to 2023. From what I hear, from where I am, from where I sit, folks are saying, what are we going to do? How are we going to get through the retail season? What is the Fed going to do with interest rates? Where is the market going to be? And they're taking a very cautious approach. What I do see more specifically is the large banks tightening up their credit policies and increasing their due diligence. And what that's doing is it is having a negative effect on the M&A world because it's taking longer to get transactions done. And I can't tell you how many times someone came to us the day after Thanksgiving and they woke up and said, wow, I need to close this by the end of the year. Can you get me an appraisal before Christmas? And we kind of looked at them and said, we'd love to, but the queue is pretty full with folks who got to us by November 1st and said, I want to close by the end of the year and I want my diligence done. So right now we're working through, like I said, we're working through a glut of appraisals, and that's my competitors as well. I've spoken to all of them on a high level basis. They're all going through the same thing where diligence is taking longer, banks' credits tightening, and look, M&A for 2023 is really something that's still up in the air.
So this question's for both of you, and I know we've all faced this. You hit the reality as a CEO or a CFO that, hey, look, at the end of the day, I'm gonna bust a covenant here, or I'm gonna have a lot of ineligible inventory, and my borrowing base is not going to be sufficient to cover my cash. We've all dealt with that, and but let's give some advice here. It's coming. You can hear the train, but you can't see the light yet. What do you do if you're about to face a situation where your lender is going to go ask you to go find some new friends? Joe, start with you.
The finding new friends conversation has happened a lot more often recently, Mike. And again, this goes back to big banks tightening their credit policies. The private finance companies find themselves in a pretty good spot right now. They're looking at providing companies with more flexibility. However, can those companies tolerate the interest rate change? Because they're not, these asset-based borrowers, these secured borrowers are not getting L200 or L150 from their big bank anymore. They're paying L400, L600 for we'll call it a basic revolver. And that's probably the toughest thing in the world is the sticker shock, because also along with that sticker shock is the expense to make the change. Because when you make the change, we all know between legal and diligence costs, it can be very expensive for any size borrower to move their relationship with a secured document. Like I said, I think that there's a lot more to come before we know what's going to happen in 23. But at the same time, banks are starting to push the borrowers towards the door. And as you say, you need to find a new friend. For the borrower's perspective, the company's perspective, to properly prepare for that, two things. Make sure your operational efficiencies are in order. And if there's certain things you can do, low-hanging fruit, to improve those efficiencies, get those done now and don't wait. The second thing is, I've said it 3 or 4 times already, you really need to cut your inventory down, take your working capital issues out of the picture, and show yourself as having the ability to generate some liquidity, keep it on the balance sheet so that you can stave off any massive issues that could come out of this upcoming this upcoming period.
Yeah, I'll add a couple of things to that. The most successful clients that I've assisted in getting through very difficult refinancings have three things in common. One, they've cut every amount of cost they can cut. Absolutely have become lean and mean and know they're operating at their best possible margin level. I think the second thing that I've seen them do is be incredibly transparent with their lenders. Don't mislead. Don't try to sell yourself out of a bad situation. Come clean with your lenders, because lenders can help you not only stay within the bank, but also they can help you get out of their situation. So that relationship, even though it's not at its best and highest level, is still a very, very important relationship to be very, very transparent. The third thing, and I think this is probably the single most important, manage liquidity. You've got to have cash flow reporting. You've got to have cash flow forecasting, and not just checkbook forecasting. I'm talking about real analysis of what you're really collecting versus what you're really paying out, and a whole emphasis on working capital. Those three things tend to open the door to being able to get refinanced today. And even in a tough market, good companies that are well managed will have access to capital. Looking at the M&A market potentially drying up, potential default situations with some of our customers and retailers and so forth, as they look forward, I mean, given all of this news, how do they prepare, Ron, for potential issues with their lender in terms of potential default, potential forbearance, things like that?
As the two of us know, Mike, from hard matters in the past, the biggest challenge we have is getting our clients to recognize that there are defaults and that they have to start addressing them. Too often they think, well, they're going to work out. The bank's going to be fine. I've been with this bank for 20 years. They're my friends. And they don't appreciate that it is a business from the bank side and they have to do it. So we end up spending more time on the front end educating our clients on why it's important to do exactly what you said, to be transparent, to reach out to the bank early and say, this is coming. As Joe will probably reinforce, bankers don't like surprises. They want their clients to come to them answering the questions that I know they don't, that Joe talked about earlier. So we have to be prepared and we have to be transparent. And then we have to get everyone realistic on what's going to happen. Joe says sometimes it's best to go find a new friend. The reality is it's pretty hard to find a new friend. And it's pretty hard to find a new friend typically within the time frame that the banks want you to move. Mike, you and I've had a couple deals over the time where you said, we need 6 months to right our ship, and then I can get you out. And you've got to be able to work with your existing bank to try to address it. Come in with the plan. As you said, improve liquidity, get rid of some inventory, just bring in the money. The challenge you have is the bank's going to often make a grab for the money, and while it may be the right thing to do on our side, from the company side, the banks may be aggressive. And what we typically do when we want to sit down is, it's the valuation question from the day one to the company.
Right.
Do we believe the bank is oversecured or undersecured? And what we want to do is we want to make sure, to the extent that they're undersecured, tell the bank, we're your friend. We want to work cooperatively together. Our goal is to get you out, to keep this company as a going concern and survive. The other thing we typically want to do to prepare, and it's a harder discussion, is do you believe that your banker trusts you? Do they trust your numbers? Do you have a history of giving good numbers to them? Are there challenges? Are there issues that you've had historically? Because we're hired guns, Mike. We come in, too often we come in too late, and where the die has been cast. So with those, if we could, in the perfect world, if we could come in the first time before, these are what we want to do, and educate them to say, anticipate the questions that Joe I said at the outset on what every ABL lender wants to know, and figure out how we can come to them with a solution. The bankers don't want us to come to them and say, we're going to be in default. Give us 9 months. We'll figure it out, and we'll be back. But you'll be good. Your collateral position's protected. I assure you, that's not how they look. They're going to say, okay, we're going to take a snapshot today. It cannot get any worse. How is it going to stay the same or get better? Because we cannot risk getting into a worse valuation position from the bank.
Good point. I haven't heard that from many lenders. Don't make my situation worse. So that's exactly what they're looking at.
Mike, real quick, I just want to reemphasize one thing. I think Ron made an excellent point, but how much time will it take to right the ship? You need to recognize that as a company. And I'm sure you've been put in that position before, Mike, where you're trying to get your client to recognize that now is not the right time and when is the right time. Because the one thing I have seen is I have seen 2 or 3 failed moves in the last 12 months. And those failed moves have resulted in double diligence, extended costs on legal. There have been, closing dates pushed off significantly. You need to really make sure that if you're going to make that move, that you are ready to make that move.
So,
but I would go back to the point in saying, I would want to. Often your best friend is your first friend on this. Mm-hmm. I mean, I want to try to do whatever we can to work with the bank and convince them that we should stay there rather than doing it. Mike, you and I have had both a number of cases we know where emotion gets in the way. The client gets mad at the bank gets mad at the client, and the client says, I've been a great customer for X years. I've paid you everything. Now I'm having a hiccup and you want me out. They need to try to work together, because unfortunately, in a lot of those circumstances, when they go to the next bank, it may not be a traditional lender. It may be a lender of last resort, and it's going to cost more, and you may have a great 30-day honeymoon, but soon thereafter, it may not be where you want to be, and you may end up in a liquidation. So I really like to tell my clients, we need to find a way to, if we can, to fix this and work within the lenders and listen to what they say. Ultimately, my job when representing them is to, we have to maximize value, but we want to keep going concerns. We want to keep jobs. And in a lot of these communities, that's the message we want. And we need to play off that with the bank sometimes as well.
Well, I mean, don't you really want to stabilize your company before you go through a refinance process? So the longer you can get your existing lenders to either work with you or to give you time to make that transition, the better off you're going to be with the next lender, because your business is going to be much healthier as you start going through their due diligence process. So I think it's important that everybody continues to focus on one thing, and that's improve the business proposition.
Yeah, you have to. Otherwise, if you came to this bank, your current bank right now as a new customer, and said, would you make this loan? They'd say no. Show me what you can do for the next 2 to 3 quarters and perform. So that's the answer. If you want us out of the bank, give us that opportunity to go to somebody else and make that loan.
So all 3 of us were part of working in these industries in 2007 through the 2010 last major recession. Joe, starting with you, what's different about what we're hearing about the future versus what really happened in the 2007 recession, 2008 recession?
Well, first, Mike, the banks are better prepared. Let's be honest, all the regulatory I'll call it the regulatory changes that they went through. That's not necessarily what we called it when I was working there, but the regulatory changes on top of the balance sheet requirements, right? Because now the banks are required to carry certain capital, for their portfolio. It's representative of the risk that they're carrying in the portfolio. The banks are better prepared for that this time around. So, first of all, it's sheer preparation. Second, I think there's a lot more liquidity in the market today. And even though we're sitting here talking about declining liquidity, declining values on the customer level, there are private equity firms out there. There are large companies that are out there who are sitting on piles of cash that they, either came upon during COVID or that they've stockpiled over the last couple of years. They're going to use that to their advantage. and there's going to be winners and losers. And unfortunately, the losers are going to go away. They're not just going to lose. They're going to become, consolidated into a larger company, or if they don't have a reason to exist, they may just fade away into the sunset. I think right now the biggest thing is the liquidity that we have in the market today is going to drive us to a better place through this particular let's call it period. I keep calling it a period because I don't want to call it a recession.
Well, I'm not sure anybody understands how to define that right now. Anyway, there's so many mixed signals. But at the end of the day, Ron, what are your thoughts on that? I mean, obviously, it was a frantic period then. Are we expecting the same depth and longevity from your perspective?
Listen, 2008 downturn, we saw a significant uptick in bankruptcies. What was different, I think, about some of those bankruptcies were that there was really retailers and other companies were not really given the opportunity to restructure. There wasn't as much, as Joe mentioned, of the private equity liquidity there to bail them out. Everything was troubled. And the banks were going for what I saw then as a very quick solution, and that was sort of starting of where we still are. I don't know whether the banks, when they see trouble, are going to allow for extended bankruptcy cases and the true reorganizations. If there's going to be reorganizations, many of them are going to have to be what I think is prepackaged. They're going to have these negotiated in advance, and whether they're really balance sheet restructurings or operational restructurings or hybrid. It may be that the balance sheet restructurings are what's going to we're going to see focus and where we're going to see restructurings. The lenders don't want to pay the cost anymore. And so I think we're going to see them. We're starting to see increases. I mean, their business bankruptcy filings increased in September 16% year over year. There has been a number of significantly new bankruptcies. When you look at the watch lists that we have for retailers and others, when you saw earlier in the year, there were very few on the list. The list is growing, whether that means anything or not, but there are more and more on the list. And we're from the legal world, we're seeing more calls. Our pipeline has increased, and folks are saying, "What if? What can we do?" And it's not just on the company side for where they're going to file, but we're looking at more supply agreements for our suppliers and saying, okay, what can we do to tighten this up to do it? We're seeing increased, concern or trauma in that industry. Is there a way for us to get out of these agreements of bankruptcy? Suppliers that sometimes that are paying signing bonuses or rebates, or revising their agreements to eliminate those, or making sure that they're not eligible if they're defaults and bankruptcy and clawback procedures. So I think we're seeing different types of coming. I'm hoping that suppliers are once again better well prepared, because once again they should not be surprised. But I think it's coming.
After the first quarter, obviously, that's when you see the flurry of activity in retail in terms of potential retail bankruptcies. And we've seen, ebbs and flows of that over the past few years as we've transitioned away from brick and mortar, online, a lot of COVID. As we start thinking about Q1, are we going to see a bloodbath in retail, or are we going to see the strongest survived and they've adapted and this is what we've got now going forward in retail? And the reason I'm asking that is you're hearing such news out of even Amazon shutting down the building of 36 distribution centers, even here in Metro Atlanta area. And you start thinking about what we heard from Target and the inventory issues there. What's your perspective? I mean, is it going to be the retail demise that a lot of people have predicted?
Mike, I'll take that one first. I don't think you're going to see the retail demise that's being projected, but at the same time, what's going to happen is, like I said before, we're going to get through the next 2 weeks, and retailers are going to have to significantly discount what's left on the shelves to create liquidity to make it through to the next big period. So, from that perspective, it's all depending on how big of we'll call it a loss they take when they take their discounts. How big of a loss is that going to create? And can they withstand the liquidity pressures as they continue to work down their inventory? And if they can't, then Ron, I think they're going to end up in your box.
Yeah, I don't think we're going to see the bloodbath, Mike. 2020, 2021 was like we've never seen before. That it was pandemic, but it was a bloodbath. And we're not, some of the signs. I mean, I do a lot of work on the shopping center and the developer side. We're not getting massive requests yet for lease modifications. We did a lot of lease modifications in the past 12 months to try to shore things up, extend terms, but we haven't seen that yet. And that sometimes is something that from the landlord side we look at to see what's coming. I think we're going to see some. I think there are some folks who feel that we're going to see it in the apparel industry, not on the retail apparel, but those who are supplying to them. Just sort of Joe's thought: do we have too many different types of sneakers in our store? Can we eliminate those? Reluctantly and unfortunately for me, because I like bankruptcy, but I don't think it's going to be the bloodbath next year, at least not in the retail. I think there'll be other things. There could be things in the supply chain industry. There may be industry segments. I continue to believe that there's concern in the restaurant, the fast casual, because certainly if gas prices and medical costs continue to go up, there may be less money for folks to go out and eat.
So, as we've all discussed before, bankruptcy is not the only solution when companies get into trouble. Actually, it's what we've all suggested is probably the absolute last resort. And I have a lot of clients that get into trouble and they think bankruptcy is the solution here. It could be part of a strategic solution set, but not always the first solution. With that, Ron, how would you define the perfect situation that bankruptcy solves versus situations that are really not bankruptcy solutions?
The first thing we do when we sit down with a client who says, let's file bankruptcy, it's a story. Tell us why you're here and tell us what in your world is the end of the story. How do you want to get to where you want to be? Is it a restructuring? Is it, what do they think bankruptcy will do for them? Now, there's certainly, when you look at the history of retail, bankruptcy has served its purpose for rejection of leases that are unprofitable. They're over market leases. It's a way for retailers to shut down locations almost free, if you will, by only having to pay nominal amounts to unsecured creditors in bankruptcy. I mean, there's costs and risks associated, but the successful bankruptcy cases, that's largely why they're filing, because it's the lease and the ability to reject leases. The perfect scenario is really where you can do a prepackaged restructuring and get in and out quickly and reach agreements with your lenders or your equity holders on conversion of debt for equity or new money coming in. And you're really doing a balance sheet adjustment, or you're providing new and additional liquidity that you may only provide if you can wipe out, if you will, unsecured debt or take care of some of those other things. So, you have each situation, Mike, is different. You have to approach it with a creative mind and really try to understand what's the ultimate goal. Is it, how far down the road are you and what are you able to do? And the successful ones are the ones that go in very quickly. There were a number of major retailers that had record filings in 2020 and how long they were in bankruptcy. A couple of them were in for under 12 hours between the actual filing and the date of confirmation, and they seem to be doing well now. Those are once again, those are the balance sheet adjustments. And if you're able to do that, you and I, unfortunately, historically, have never had the luxury of a lot of time in advance. But if we could, bring us in earlier, bring you in earlier, work with the Gordon brothers and the valuations to understand, and let's see what we can do with time. Because once you're out of liquidity, you have no choices. Wouldn't
you all agree, though, that the most important thing that companies, both brands, consumer brands, retailers can focus on right now is the sheer fundamentals of running their businesses for the maximum amount of profit they can run it, which includes cutting costs, selling down inventory, revising SKUs, making sure that you've got outstanding customer care right now, which is, someone asked me the other day, when you get great service today, what is your first thought? And my first thought is, I'm stunned. And so customer care at both the retail level, brand level, as both suppliers, manufacturers, and so forth, really will be the key to survival, because as we've all seen, there's zero way you can operate in this environment as a consumer brand or a retailer in a vacuum. You have partners that are lenders, you have partners that are suppliers, partners that are customers, partners that are warehouses, and everybody's got to come out at least even or a winner in all those interactions. So as we look forward and we start thinking about, you're a retailer, guys, you're a CEO, what are you doing right now, Joe, to kind of put your own insurance policy in place as you prepare for the unknowns of Q1, Q2, and Q3 of 2023?
The first thing, Mike, I mean, you really need to, take a hard look at first inventory levels. We've said it 100 times, but employee levels and operating efficiencies. And look, there was a lot of demand that has waned some, and you may be able to make a head count cut here or there. But at the same time, if you're in one of those bright spots and you're looking at a positive Q1, Q2, you want to get ahead of the curve and hire, you probably have the liquidity to do it. You've probably made some of the changes necessary so that you can spend a couple more dollars to be one of the 800-pound gorillas as we continue on through this period. So my best advice is take a look at your operations as a whole and don't look at just the top line. The top line does not tell the whole story, and you really need to dig into the nuts and bolts.
Got it. Ron, your thoughts on how you would advise your clients?
Yeah, I agree with what Joe said. I mean, we want our clients, to the best they can, is to look into that crystal ball and be realistic. What do they realistically think, not what they hope they can achieve during the year. And I know that's challenging in this retail with an ever-changing, but I'm telling clients to take a conservative view of it and under promise and over perform. If you're in covenant default with your bank,
lenders love that, Ron. Under promise and overperform. Sorry, had to just say it there because that is critical.
Yeah, I mean, don't. And Joe, you'll appreciate that. Don't just tell your banker what they want to hear, so they smile. But if you can't achieve it, you may get one free covenant default. But if you continue to trip your covenants because you've overpromised or you're not operating your business, you will be visiting me much more, and we'll be in bankruptcy or we'll be forced liquidation, and it just impacts your value. And if you were trying to sell it and they see a history of tripped values because you've missed your numbers, that's a buyer's going to look at that as well. And be realistic and try. It's a difficult market. It's difficult to plan for record interest rate hikes in a calendar year that you may never have heard of before, but you've got to try to be realistic and test everything. And once again, work with everybody on all sides, your suppliers and your lenders.
So final question for both of you. I'm going to put you both on the spot, since we've all been great prognosticators over the past 20 years, and we've missed the recession probably the last 10. On a scale of 1 to 10, 10 being Armageddon and 1 being incredible growth and incredible profitability, what does it look like for the retail and consumer channel in 2023 on that scale of 1 to 10?
I'll throw the first ball out here, Mike. It's probably a 6.5, and the reason it's not a 7 or an 8 is because I still think that consumers over the next couple of weeks are going to ignore all the signs, go out and create what we all like to see, which is a good holiday season. That's me. That's me here, not in Vegas. But what I'm saying is I really think that folks are going to continue to spend throughout this holiday season, which is going to keep things somewhat tame. But there still needs to be some significant changes. There's actually less e-com being sold year over year. Obviously, during the pandemic and the year following, no one wanted to go to the stores. No one wanted to go out, so they ordered everything through Amazon. But when Amazon starts shutting down plans for distribution centers and there's more foot traffic in the retail stores, we all get a little confused now, saying, wow, we thought brick and mortar was going to go away forever. Well, it might be here to stay for a little longer.
Yeah. Ron, your thoughts on that scale?
I actually think his number is pretty spot on for the retailer side. I think that for next year, I think the consumer number, though, may go down because I think there's going to be some harsh realities in the consumer world. I don't think it's going to be Armageddon for retailers. I think it'll be okay. But I think the consumers are going to have some harsh realities that are setting in. For whatever reason, they're getting caught up in the holiday season. I think next year you're going to see the impact fully of rising medical costs. Gas prices have dropped $1.77. Mike, you commented to us the other day, well, that's because they were at $9 in Atlanta. Maybe they're down to only $7 now. But for those of us in the heartland, we've seen stabilized gas prices that are still high. Where's the consumer spending? The housing sales are going down, at least in the Midwest where I am in Cincinnati and in our comparable cities. Our automotive sales and car dealerships, they finally have some stock inventory back after the slow. But I see some full lots. I mean, used cars, are going up ridiculously in price. And I think, I think there's going to be a harsh reality for the consumers, but it may take a little longer to reach to the retailers. I still don't see it being an Armageddon. There frankly aren't that many retailers left to file that haven't already filed. And those that may file maybe actually deserve to. They've earned the right.
Thank you, guys. Before we close, we've got just a few minutes. If anybody wants to type any questions in the chat box, we can take a few questions, and if we get them after, we can respond back via email. So if there's no others, I want to thank both of you today for your insight and experience. And I can tell you that having worked with both of you, both your firms and you individually have been a great assistance in helping not only my clients, but clients you brought me into in surviving and getting over bumps in the road and sometimes mountains. So really appreciate your insights today. You got a great experience. And if that's it, we'll close the session and look forward to catching up in 2023. So happy holidays.
Thanks, Mike.
Happy holidays.
Ron.
Happy New Year.
Happy holidays.